So at the purest debt that people know about is bank debt.
Yeah.
From there, you have different types of debt. And as you move away from banks, it gets riskier and it gets a little more expensive. There's financing receivables, there's SBA loans, mezz debt or sub debt. And there's another thing called convertible debt.
Generally speaking, take all the money you can from the banks. That's the cheapest money you're going to get. Once you start moving across the spectrum, it gets more expensive, with equity being the most expensive if you are successful.
Hi everyone, this is Aleksandra Szuszkiewicz and you're listening to Investor Report podcast. Today we have a second part of the conversation with
Damon Kirchmeyer.
Bill Kurth.
Nice to have you here again. So this second part of our conversation will be about the financing opportunities for the businesses. All right, starting off, please introduce maybe briefly yourself in case somebody didn't watch the first part, and then we'll jump right into the topic.
Bill Kurth, I'm a partner with Rectify Partners. Historically, I am an angel investor, a partner with Rectify, and have invested in many other companies and spent a career lending to companies as well over the past 30 some odd years.
Yeah, I'm Damon Kirchmeyer. So most of my career has been in investing. I've had raised two small sub-debt funds and invested those, made more than 100, probably more than 200 investments over about 20 years, and then took a turn on the other side of the table as a CEO in a startup company.
Love it. Okay, so starting off with the topic, could you please tell me what are the differences between the traditional funding that companies may take and the angel investors and also like business investors? What is the difference between the two?
Let's start off with debt. So at the purest debt that people know about is bank debt.
Yeah.
So banks will lend money to companies for a very, very low interest rate. The reason why they do is banks have access to our deposits, meaning we deposit our money into the bank, they take that money and they lend it to other companies. Because the banks are using our money to loan, they're regulated by the FDIC or the OCC, who paint a very small credit box on who they can lend to so you don't lose our money and create widespread panic and hysteria. So that's a bank. If you don't need money, the banks will give it to you. That's a joke, I'm kidding. But
Bill didn't mention, but he's a reformed banker.
Yeah. Early in my career, yes. From there, you have different types of debt. And as you move away from banks, it gets riskier and it gets a little more expensive. So
you say that bank is the cheapest option?
Yes,
okay.
Because you have to be in a very narrow credit box that's regulated by the government, essentially. Okay. So outside of that, if you don't fit in that little credit box, then you go out to other forms of finance. And there's so many types out there. There's financing receivables in the form of factoring. There's SBA loans, which is a bank loan that's backed by the federal government. So it's a little more expensive, but the government's backing these companies up. A little more paperwork. You've got different types of equipment finance, and you've got...
Yeah, explain each of them. Like once you mention them, explain at least like one sentence maybe.
Yeah, okay. So receivables financing, if a business sells to another business, it's done on terms. So if I sell to a consumer like Damon, he swipes his credit card, I get paid right away. But if I sell to, say, Costco or Home Depot, they will take 45, 60, 90 days to pay me back. The problem is as I'm waiting to get paid, I still have to pay my payroll, I have to pay my vendors, pay my rent. So you have to borrow money against those future receivables, which is done in either factoring, which is a purchase of receivables, or a line of credit, which is lending on receivables. From there, you've got equipment financing, where you finance equipment you want to buy, or a building finance.
How does it work?
Well, basically, you want to buy a building, they're going to lend you a percentage of the value of your building, LTV, loan to value. Then you have X amount of time to pay it back in what's called a term loan. So it might be a 5-year term or a 10-year term. But an amortization schedule dictates what your payments will be based on principal and interest over so many years.
Okay. So like taking a loan, but for the equipment, you are taking the equipment and then paying it off.
Yes, yes, exactly. From there, and there's many different types of that. From there, you got what's called a hybrid. And actually, Damon built a career out of doing one of these hybrid, which is mezz debt or sub debt when I first met Damon. And do you want to explain that since that's your expertise?
So what we did, we went into early stage companies. We were a private company, raised a traditional venture fund, but the mechanism was not straight equity, it was debt with warrants. So we would loan to a company a fairly substantial interest rate. It was much higher than the banks because we're taking a higher risk.
Why, sorry for interrupting, why companies decide to take the higher interest rate? Is it because they are not qualified for the smaller interest rate for the bank? Okay, gotcha.
Yeah. Generally speaking, take all the money you can from the banks. That's the cheapest money you're going to get. It just is. Once you start moving across the spectrum, it gets more expensive, with equity being the most expensive if you are successful. So we would do debt and with warrants. So we also got a small percentage of equity with each deal. And what that allowed the company to do, generally, they were taking our money and doing one of two things. They would grow the company to a point where they were bankable, and then they would take us out with bank debt. Or they would grow the company and then go get traditional equity investment to continue and further accelerate growth.
Maybe explain what warrants are too.
Yeah. That's what I wanted to ask.
Warrant is it's a piece of equity. It's the right to. So if I invested or if I loaned you $500,000 for your company, I might also ask for 100 shares of stock in your company. Pricing to be negotiated either based on the next round, or we set a price today. And so we would get a little piece of equity with each one of these deals we did. So it was a hybrid.
What if I don't sell stock? Is it you take the percentage then, or?
Yeah, well, in the case of an LLC, it's membership interests. It's
okay. It can be. It can take all the different phases and.
Yeah, just a piece or a percentage of the equity.
Okay, so the warrant is it's always equity. There's nothing else that warrant could be.
Well, there's also a spectrum on that. So
Love it.
There are cases where we had a warrant for a percentage of the equity, and then we sold it back to the company. The company just repurchased that from us because at a future date, which just for all intents and purposes just made it a slightly larger payback from the loan. So there is that. There were times where we hung on to the equity all the way to an exit via sale of the company. Actually, I don't believe that we had any of them go all the way to an IPO. But we could sell alongside of the company. We could sell our shares into the next round if equity investors came in and wanted to purchase our shares. We would do that, or there were times where we sold the equity back to the company.
So if they give you the warrant, that means that their the debt will be cheaper for them, right?
Well, again, it all depends.
Okay.
It all depends. And in the case of mezzanine debt is essentially the space that we were in, but we did what's called subordinated debt. Subordinated meaning if a bank came in and wanted to lend, we would take a lien on assets of the company. You file with the government a UCC filing, which establishes your position in the stack of debt. If a bank came in, we would subordinate our position, let the bank take the first lien in the UCC. So in doing that, we were taking a higher risk. And anytime, this is how every investment is priced from debt to equity. It's perception of risk. Okay, so ours was more expensive than the bank because we were taking that risk. We would subordinate to the banks. They weren't bankable at the time that we came in. So we would supplement that risk with a higher interest rate and a warrant.
Okay.
Yeah.
And that's kind of what you're always trading off. What is your risk? Anything you can do as an entrepreneur to reduce the risk, you get cheaper alternatives.
He went back to a good point, which is banks are what I call senior secured lenders. And so you've got senior secured lenders and subordinate lenders. And so think of a senior secured lender like person who's first in line to take the assets. So there's a thing called UCC, Uniform Commercial Code, which is filed by a state. And a UCC filing is kind of like a title to a car or a deed of trust to a piece of real estate. It's showing ownership of other assets other than, the car or real estate. So a company has many assets. They've got their buildings, they've got their furniture, they've got their equipment, they've got their trademarks, they've got their receivables, they've got their inventory. There's a lot of assets in a building. UCC determines who has right to those assets at any given time if the company were to go out of business. Okay, that's Uniform Commercial Code, filed by a state. Most banks will file a UCC filing. If I'm an equipment lender, I'll file UCC on my piece of equipment. If I'm a receivables lender, I'll file on my receivables. If I'm an inventory lender, I'll file on my inventory. So different creditors, lenders, will file UCCs on different pieces. Or a bank might file what's called a blanket filing, meaning all the assets of the company. Now or acquired in the future, they own all of it. So what Damon is a subordinate, meaning you got your senior secured lenders here with all the assets. Well, Damon as subordinate has no assets. So if the company goes out of business, everybody goes in there and takes their assets and sells them and makes themselves whole. Nothing left for Damon.
Oh, okay.
He's subordinate. There's nothing left. So because of that risk, he's going, okay, wait a minute. I'm taking risk. Therefore, rather than have an asset, I want a piece of the business. I want a piece of the ownership because I'm taking an equity-like risk. So I should get an equity-like reward. And that is in the form of mezz debt, which is no collateral to back it up. Does that make sense?
Yes, that makes sense. So then when you sell off all the assets, there's also the asset as a company, as a business. There are revenues that they are running. So you will share those revenues, right?
Well, if it comes to the point where they're selling off the assets, there's
no more revenue.
It's done.
So he lost. Basically, that's the risk, is if a company goes out of business, all the creditors will take the little piece of equipment and maybe they'll recover 70 cents on the dollar by selling the assets. This is worst case scenario. Damon would have gotten nothing. There's nothing left. So he bet on the company being successful.
Okay.
Yeah.
But again, when you're dealing with any equity, the ultimate risk is the ultimate reward.
Yeah.
Right?
Yeah.
If the company does well, he makes a lot of money. Company does not well and goes out of business, he makes nothing. Like an investor.
Yeah.
It's the very same thing.
Gotcha. Can you, as an investor, be a secured lender? Or only banks can do that?
No. Anybody can. I know there's a lot of what's called shareholder debt. Usually shareholder debt is subordinate to senior lenders because they're involved in the company. There are times, though, when a shareholder does take a UCC filing on a specific asset. They can do it. I've seen it done.
Yeah, if you're asking, you can't, it's not available only to banks. You could loan money to me and file a UCC.
Okay.
And that information is publicly available. You can see what debt has already been put on the company and who's in line.
Yeah.
Okay, so I can, if nobody is in line, I can be a senior lender.
Yes.
It's just a matter of me filing the CC. UCC filing.
Uniform Commercial Code.
UCC. Okay.
And if you're first, you're first.
Okay.
Now, a bank may come in, if the company comes in, the bank says, hey, I'm going to loan you money, but I have to be in first position. So you have to tell her to subordinate to us. And you file, you sign the documents to allow them to move in.
Yeah.
So it's like your friends waiting in line to get a sandwich, and somebody comes and says, I want it first in line. She lets that person butt in line in front of them. She doesn't lose her position, but somebody butt in front of her, which is the bank.
Okay. But they need to agree. The rest people in the line has to be...
Yes,
okay.
they'll have to agree to subordinate to the lender, which usually they'll do it because the bank money helps their position as well. So...
the company grows.
Yes.
Yeah.
Yes.
Okay. There's a lot of things to that. That's insane.
You can go to, and there's another thing called convertible debt, which is also a hybrid. And that's a debt that's, I give you money today, and here's a loan, but in a future date, all the debt will convert to equity.
Okay.
In a mezz debt, the loan always stays the same and you get a small piece of equity. But in a convertible debt, this whole loan will convert to equity. And they never pay it back.
Oh.
And a typical, convertible loan, what it'll come in, say you put $100,000 into the company. You put $100,000 in, and it usually comes with an interest as well, interest accrual.
Yep.
So maybe it's 10% interest. So that $100,000 accrues interest.
Yeah.
And then let's say 2 years from now, an equity investor comes in and puts money into the company, it will convert at that round, usually at a discount to that round. I'll explain that in a second. Plus all of the interest. So you may have another $100,000 in interest at that point, and $200,000 converts into equity.
But the interests are going to be paid to you. So how does it work if you get...
The interest only accrues.
Accrues, okay.
It accrues, and then it goes right to the conversion into equity. Yeah. So
What needs to happen for that to happen?
A qualified financing.
Yeah.
Usually in the convertible note, what's specified is that there is an automatic conversion of your note to equity upon a qualified financing, and you agree upon what that is.
Or a period of time.
Yeah. Or you can have, or you can say if it goes 5 years, then that's it. We want to convert, and you often have, as the note holder, you often also have the ability to just keep it as debt and have the company repay you.
Okay.
So it gives you a lot of flexibility, and one of the reasons that people like to do it is that you get around having to value the company right now. Early stage companies, it's hard to value a company especially when you're pre-revenue or you just have a little bit of revenue or you're an unsophisticated investor. It can be hard to really peg a value to the company. So you say, we'll do it at a convertible note, and guess what? I'm just going to convert at whatever value you sell equity in the future, but a 20% discount.
Okay.
That's typical, about a 20%. So if you sell if you sell equity $1 million valuation, I get $800,000 valuation. I get more equity plus my interest.
Okay.
So it's a good deal for them.
But can you decide not to convert your debt to equity?
Yeah, you usually have the opportunity to just keep it as debt and have the company repay it. You'll have to establish terms. Sometimes that's specified in the original note. Sometimes it says, we'll have to determine that at the point when it comes to that.
It's usually up to the lender or / investor.
Yeah. What if that major event never happens?
Yeah, if it never happens, there's a couple of alternative conversions. Usually what you'll do is you'll specify in there, if said financing doesn't take place within 2 years, you specify a time. If it doesn't happen, then my note converts at this value.
Or have the opportunity to do it at this value.
Okay.
Yeah, I don't have to.
Yeah, I have the opportunity to convert at this value.
And usually it's at a relatively low value. It's an advantage to the lender, the investor. So it's an incentive for the company to go out and get additional financing. And you set a qualified financing because you don't want it to be you borrowed $500 or you got a $500 equity investment from your cousin. Right? It needs to be $2 million or $10 million or whatever you guys establish as significant.
Okay, so qualified would be bigger, or qualified would be from different lenders than family?
Yeah, it generally is just a size. So you determine
$1
it has to be at least $1 million. And if it's $1 million and that's a qualified financing, then we agree that that would be a qualified financing event and we can convert.
Okay, that makes sense. Any other ones?
Boy, there's a myriad of them. But it really comes down to, again, what it comes down to is there is bank debt, there is non-bank debt, and these are most of these two classes will file a UCC. A bank will file on everything. The non-bank debt will file on their specific assets. They tend to be more specialized. Then there's the two hybrids. Then there's equity.
The bank needs to, and usually files the UCC for the entire business. Why the lenders can do the same? Why they are filing only for the asset?
Banks are usually what I call generalists, all right?
Okay.
Because they're lending on such non-risky, stable companies, they can do everything. As you get away from the stable companies, the riskier, people tend to specialize in their particular type of lending and asset because you really control the asset and you have to know it very well.
Gotcha.
You have to pay more attention because these are riskier companies, which could go out of business a lot more than the banks. So you tend to specialize in equipment or vehicles or receivables or purchase orders or whatever the asset class is. They're going to really focus on that. But these are all senior secured lenders for the most part. Then you get into the subordinate lenders, which are things like convertible debt, mezz debt. Then there are groups that will lend on no asset class, which is called revenue-based finance. They will lend on your historical and future earnings of a company without really attaching to a class. That's called RBF, or revenue-based finance.
Okay.
So what they're going to say is, hey, listen, historically, you've been doing $10 million in trailing 12 months. So based on that, we're going to lend you $250,000, a portion. And we're going to take a percentage of your revenue going forward, expect to be paid back in 3 to 4 years.
Okay.
So every time money comes in the company, they're going to pull maybe 3%, 4%, 5%, whatever it is, based on the historicals and on the future earnings of the company. There's not really an asset class. They're not lending on an asset. They're lending on the projected and historical revenue of the company.
Okay.
That's called revenue-based finance.
Okay.
So
okay.
needless to say, there's a lot of different types of financing out there, debt financing.
Yeah, RBF it's worth going into a little bit further because a lot of people don't know about it. It's a great opportunity for some companies. And the minimum qualification is you have to have a large gross margin.
Yes,
Okay,
at least 40%.
Yeah, if you have a substantial gross margin, this can be a really good way to grow your business. Because imagine if your gross margin is 50% and you've agreed to repay the RBF 5% of that.
Yeah.
So what you've done essentially, you've taken your gross margin from 50 to 45.
Yeah, it's like nothing.
Yeah, and if you can still live on 45, then that can be a pretty good method
if
for
you had a 10% gross profit margin, took it down to 5, it's a kiss of death.
And
that's why they have that, it has to be at least 40% gross profit margin is what I see.
Yeah, and again, on that spectrum, this is a riskier investment for the investor. So it tends to be expensive.
Yeah.
What they'll do is usually there's a payback, and it might be if they loan $250,000, the payback might be 2 times their money.
Yeah, it's usually a 2x return
in 3 years.
Yeah.
And so we're going to take 5%, and we project that by taking 5%, we're going to hit $500,000 in 3 years.
Okay,
and that may need to get adjusted down the road if you're not on target to hit that. Maybe the time, maybe the amount. But that's the way the vehicle works, and it's expensive, but again, it's still much cheaper than equity for a successful company.
But what I want to make sure that people understand is what I've seen in my years of doing this is this misconception that equity is free money. So I really want to attack that right now.
Okay.
A lot of business owners who think that if this person gives me $500,000 and I give them 20% of my business, who cares? It's free money. I don't have to pay it back. I don't have to sign a personal guarantee, which I want to go to in a second. Let me maintain that the most expensive financing you will ever take in your business is equity if you're remotely successful. I'll also say that equity is like a lifelong marriage and debt's like a 2-year fling.
Yeah.
It's very important to understand because debt, regardless of how expensive or not expensive, is temporary. You can pay debt off at any time if there's not a prepayment penalty. But for the most part, you can pay debt off any time and you still own the company. Once you give away equity, that's forever and it's multi-generational.
Yeah.
I'll also tell you this, going back to the earlier conversation of a lifestyle company versus a strategic exit, the minute you take equity from a group or a person, you're promising to sell your business for the most part, unless they're willing to live off dividends, right? You're promising to sell your company because if I invest in a business, 10 years down the road, I expect to have been paid off my investment back. Otherwise, I get nothing.
Yeah.
So I'm expecting in the future date
to have that sold.
Have that back, yeah. There are times when it doesn't work out, Blue Eye. I expected that to be a 3 to 5 year payback. I've been invested in Blue Eye for 10 years now.
Whoa. Is it worth it?
Yes. Because the company's doing very well. Damon was running it. And that's the one we've been talking about. He's done a great job of it. But what I thought would be a 3 to 5 year exit has been north of 10 years.
Yeah.
That's okay, it happens because the valuation is going up.
Yeah.
So that's okay. But what I'm saying is when you take equity from some of these, venture groups, private equity, even angels or family offices, you're promising to sell your business at a future date.
Yeah.
Very important to understand. So
and we always say it's really expensive, but let's put some numbers to it, Bill.
Yeah.
So let's say you took on, you had $1 million, let's make it a little bit easier for me on the math, had an $800,000 pre-money valuation. So you put in $200,000. The company's worth $1 million, that $200,000 now buys you 20%.
Yeah.
Okay, so it's post-money value. So you just sold 20% to an equity investor, $200,000. The company is successful. You take that $200,000 and you grow it. It's now worth $10 million. $200,000 is what now? No, it's $2 million. What is the interest rate imputed on that? And it depends on the time. But you're talking hundreds, thousands of percentages depending on the time that it took to get there.
Yes.
Incredibly expensive.
Yeah.
Now, if that $200,000 helped you grow to 10 million and you're now, you now have 800,000 or $8 million in equity, well, yeah, it's probably worth it.
Yeah.
These are trade-offs. You might be extremely happy, and I probably would be.
Yeah.
But you have to realize that same $200,000, if it would have come in on debt, I would have paid it off by now, and I would have, $2 million more in my pocket. So these are all trade-offs.
Right, but they might not have got there otherwise because that's the only way they can get.
Yeah.
And there's also a thing called strategic equity, which I love to talk about because strategic is more than just the money, all right? If I have a person who invests in my company, but let's say that they're involved in my customers or they have contacts where they can invest the money and I give up 20%, they can double my revenue in a year. Okay, well, they did more than just money, right? They gave money in the company, but they also helped me double my revenue right then.
Yeah.
I'm still ahead of the game. So strategic equity means they give you money, but they do something else for your business other than just the money. It could be somewhere along your customers or somewhere along your vendors or whatever. They help your business in other ways than just giving you money, which is called strategic.
Yeah. But then you can also buy them out, right?
Yeah, or if they're strategic, they can kind of grow with you and help you grow your business if they're strategic.
Yeah.
And they have more than, they have their mind, their contacts, whatever, their knowledge that helps you grow. It's important to have a cultural fit as well because at the end of the day, it's still humans dealing with humans. And so if you're going to bring on a partner, again, it's like a marriage, you want to make sure that not only is their money good and green, but culturally, they, as an investor, fit the culture of your company. Their expectations are congruent with your company's mission statement.
Yeah.
And everything aligns. And again, at the end of the day, you're dealing with people. So they have to be a mesh there.
So why you decided on doing mezzanine debt mostly?
Well, that was
my history.
Your history. Okay.
I did two funds. It was mostly because it was a market fit. It was really a good market fit. It was primarily right around Salt Lake City. There were small deals up to $500,000, and it was a way that we could invest in early startup companies in a way that they could afford it. And we could get a reasonable return for our investors because I went out and I raised from very large banks at Merrill Lynch and Morgan Stanley and Zions and they wanted a return on their investment. And so we came up with this vehicle where we could go very broad, lots and lots of companies. We reduced the risk from a straight equity standpoint because it was debt. We were getting current payment. And so it was a way to mitigate our risk a little bit and just provide startup capital to lots and lots of companies.
But I'll also tell you, I've personally given mezz debt loans. Actually, Damon did my paperwork.
Yeah.
What I like about mezz debt is at the time I did this, a company came to me for money and it had a huge opportunity. It ended up being a huge company. I had a lot of investments here that, as I mentioned, like Blue Eye, we're just taking time. My money's sitting out there, not doing anything, sitting there waiting. With mezz debt, your money goes out, it recycles back with interest.
Yeah.
So I get my money back right away. I'm not waiting 5 years, 10 years, but I get a small equity tranche, which in this case ended up being pretty good. I ended up selling it and did well on it. But if I have a mezz debt fund, if I do private equity, I might do 4 or 5 investments. My money's gone. It's all sitting there, and I cross my fingers and it sells and I make money. With mezz debt, I put my money into 5 companies. Right away, money starts coming back to me with interest. So I can
Each
take this.
month, yeah.
So I get a small equity tranche, but that money comes back to me. I take that money, I reinvest over here. It comes back with more interest, and I get another equity tranche. I put it on the shelf. The money comes back again over here, more interest. So I get smaller equity tranches, but I get a lot more of them while my money's recycling with interest, which is one of the benefits of a mezz debt fund to the lender, to the customer. They're getting the same money, but rather than give up 20% of the business if it was equity, you might give up 4% of the business.
Yeah.
Because they paid it back. Does that make sense?
Yeah.
So I'm sold on mezz debt because been a big believer because your money it comes back, so both sides win, and it's just a great situation.
I can see that.
Yeah,
I can see that. Yeah. So how do you qualify given businesses whether you want to invest in them or not? Like, how do you do your due diligence on those investments?
I can tell you a few things I look at.
How do you do it?
We're still figuring it out. I'll tell you what I look at. Number one, I'm not this Harvard MBA. I grew up really investing by lending and making. I was involved in a few really good deals early on in my career that built some cash that let me do it. Because I wasn't classically trained in private equity or investment banking, I leverage my skills in accounting, finance, lending, and common sense, so that if something comes to me, first thing I look at it, is it a product or service I would use? Mm-hmm. Something I like. Does it make sense to me? If I don't understand it, I won't invest or lend to it. I won't invest in it, let's put it that way. So it's got to be a good product or service. Number two, the people. I mentioned before, the investments I've lost money on were those with CEOs that were not coachable. Okay. They had to be the smartest person in the room and do things their way. And ultimately, the company's bottleneck and they fail, at least in my experience. Number three, you have to have a good TAM, which is a total addressable market. Who are the opportunistic customers out there, people who would buy the product or service, all right? Is there a big market for it? Is it a small niche market?
Mm-hmm. Which one you prefer more?
Well, the big market. Obviously, you want as many people as available to buy the product or service.
Yeah, because on the other hand, why I ask, because there is a saying that if your product is for everyone, it's for nobody, actually.
The world is a bunch of subsets,
yeah.
All right? So what am I saying? Well, I would rather invest in a company selling cars than selling unicycles.
Okay.
Globally, because more people want to buy cars than a unicycle. Now, there are unicycle users out there and people make good money at it, but I want to bet on the car.
Yeah, that makes sense.
Or the bicycle.
Yeah.
All right? A larger total addressable market of people who can know how to ride it and want to ride it. Number three, of course, is I think just knowing the numbers. What's this person going to do with my money? How's my money going to enhance the company? And how's it going to get paid back? And who's going to buy the company, or who's going to invest in the company? How do I get paid back? That's really knowing the numbers from the beginning to the end. Mm-hmm. How much do I want? Why do I want this much money? Where's the money going to go? How's it going to benefit the business? And then how's the money come back to me? Mm-hmm. And all the variables in that. That's some of the things I look at.
Yeah.
I'm sure you have more to add.
Well, not really. I mean, everybody has their own method, and there's always a diligence checklist, and there are important things that you need to go through. Do you have a product that has a good margin, and is it a market that people like? Do you have you check all these kinds of boxes. Yeah. Do you have any lawsuits? And you check all that stuff off. And you always ask for a business plan, which entrepreneurs hate. Right? It's like, I want to run my business. I don't want to write it down. The reason for the business plan is to express to an investor that you understand your business. Okay, and this is in a language that we understand. I can look at you've addressed your market and your competition and your sales and all of these things. You've thought about all of those. We want to know how you think about it. And all of this stuff that we're checking off, ultimately, for me, comes down to, who am I investing in? It's the people.
Yep.
It really is. It's the people. The success and failure, always, without fails, it's the people there. There are things that happen unforeseen in the market. COVID was a terrible thing for many, many businesses. There are unforeseen things that come in, but that's very, very, very rare. It's usually a mistake by the people there, or there were changes coming in and they didn't adjust to them. So all of this other stuff we're checking off, and we want to know that you understand your market, that you understand your debt structure, that you have handle on your cap table. It's all because we want to know you.
Yeah.
Are you the right person? Because the only thing I really know about your forecast and your business plan is that it's wrong.
Why?
Because you can't forecast the future. Nobody
unless
can.
it's done by Rectify, then it's
sorry.
It's pretty good.
It's wrong, and it's. But is it good? Is it sound? And when you identify the pieces that aren't quite right, can you adjust? Mm-hmm. Okay, that's what we're looking for. Are you the person that can do that? And And it's not, it's not necessarily the smartest person that wins, because oftentimes that's a handicap, because you know the risks and you don't want to take them. It's the person that understands the stuff and just is doggedly determined, and they grind and they go and they go and they go and they push and they push and they push. That's what all the diligence is getting to. Are you that person? For me,
but also, are they coachable? That's important. They have to be coachable.
Is it kind of like a love and hate relationship between the entrepreneurs and investors, or?
It can be.
Absolutely, yeah, it can be.
Yeah, it can be. That up front, you need to match expectations. That's what it's all about. And the fault lies on both sides, because the investors don't always really, drive that, hey, in 3 to 5 years, we're selling your company and you have to be on this path. And if you're not on that slope, there's a problem. That's a tough message to deliver to an entrepreneur, because you want their business. And so that doesn't always get communicated clearly. On the entrepreneur side, there's like, I'll take your money and I understand I got to sell it, but I don't really want to sell it. That's often the case. That causes friction. Yeah. Causes a lot of friction. You need to understand each other. What does the investor want? What does the entrepreneur want? Make sure those are aligned up front, because if they're not, it is a problem and it does cause issues.
What happens if they are not aligned, if they don't, like the business doesn't want to sell and the investors really want to sell? Like, what is?
Well, the investors usually have the upper hand. Okay. When it's an equity investment in the company, part of the contract, even if you're not a majority shareholder, you often have privileges and rights to be able to get the outcome that you want. Even
if you have just 3 to 5% warrants?
That would be unusual. Yeah. Not in the case of, I'm talking about a direct equity investment. We didn't, as a mezzanine, we were a minority shareholder and minority in interest. We were along for the ride. Yeah. When you make a large equity investment from a venture capital company, you put these controls in place because you need to be able to drive that. Okay, and everything is great when you're on the slope and the path that you've projected, and if not, that's when problems can happen.
Yeah, that's where trouble comes. Okay, do you have any failure stories?
Damon.
We had a number of very successful companies. The blenders in every Starbucks, the little hood comes down over and makes them quiet. That was one of our companies. Very K-Tech, they did extremely well. Great brand, great company. I've got a great story of a company I turned down that Bill wound up working with. That's called Skull Candy. That's one of the keys as well, is that your investment vehicle has to match and be the right one for them. Mezzanine debt was not the right investment for Skull Candy at that point. It would have been, it probably would have killed them. It was terrible. Okay. So we did not, but we did introduce them to a number of other people, and ultimately they wound up getting investment, and then wound up in Bill's shop. Yep. And things went extremely well.
Yeah, it went very well. Yeah. That was a good deal.
This is also really good to mention that some of types of the debt, they don't fit well for a certain company, but maybe other types will fit better. Right. So in this case, what fit better than mezzanine debt?
Yeah, well, in their case, they needed equity.
Equity. Okay.
Yeah,
straight equity.
Needed equity. There was no cash flow to support any kind of debt repayment at that point. And so there are, there's a spectrum. Debt is almost always cheaper, but it's not always available. And obviously, equity was the right investment. They were wildly successful. They had a great IPO, and the equity investors that came in, they made lots of money too. That was a great fit for both sides.
Yeah, early stage Utah, kind of a marquee Utah deal, early stage. Yeah. And really, if you think about it, Damon, Blue Eye for both of us, I invested in that 10 years ago, but really Damon got involved with Blue Eye through mezz debt. I went to Damon, asked for, was it $500,000?
Yeah, $500,000.
and gave, was it 4% of the company?
Yeah, I'm not certain.
4%. Yeah,
Yeah.
4%. And if I can tell the story, the gentleman who's running the fund, Damon was running their mezz debt fund. And so he says, hey, I'll give you the money, but I'm going to put Damon on your board as an observer. I said, no, you're not. I've known Damon for, at the time, 20 years. I said, I want Damon as a fully functioning board member because I want Damon's mind as much as your money. So I want a fully functioning board member.
Nice.
Yeah, then it escalated, and I became the CEO.
Yeah, with stock, yeah. So he went from being what should have been just an observer board member to running the company and turning it around and growing it. But that was through mezz debt. The whole thing came across as mezz debt, right? I mean, that's how really the whole thing came together.
Yeah.
Congrats.
Thanks.
Anything you would like to add since we are at the end of the second part?
You know, there's one thing that might be helpful as well. There are different equity investors. Okay, there's a spectrum there too. Everybody has heard about venture capital. Okay, that's the sexy vehicle. Everybody wants to go to venture capital. Not every company is a candidate. They're just not. You have to be able to return a 10x investment in 3 to 5 years. Okay, not all of them do, but you have to have that potential. That is very, very rare. That's why less than 1% of the companies that start up every year get VC. Okay, if you fit that very, very narrow niche, that's great. You should go there. If you're amongst the rest of the 99%, there's somewhere else you have to go. So there's VC. You get into angel investors. Angel investors represent most of the equity investments that happen from a numbers-wise in the United States. Now, this can be an organized group. In Utah, we have UA2, we have Salt Lake County, we have Park City Angels. We've got a number of organized groups that you can go to, and they're awesome. But by far, the vast majority of equity investments are angels, which are your neighbor. It's your friend, it's your cousin, it's your neighbor, it's your dentist, it's a doctor. That's where most equity investments come from. And within those, most of those depend greatly on just the individual, the personality. They can be very casual about it. They can be very demanding. You have to be careful with those types of investments, because if your idea is you want to build a nice company, but it might take 10 years. Well, VC's not there. You angel investment potentially, but you got to make sure that you align the expectations. Like, hey, look, I think I can grow a great business, but it's going to take 10 years. Are you patient? Can you do that?
Yeah.
Have those conversations up front. Make sure that it's a happy investment for both sides and everybody's good with it.
Be open and honest about it, right?
Yeah.
One more thing I want to do about the loans. I want to bring up something that's very controversial, if you will, out there, is that of a personal guarantee. I do a lot of speaking on the subject, and I always ask people in the group, who likes to sign a personal guarantee? Nobody raises their hand. You know what personal guarantees, right?
Yeah.
I love personal guarantees.
You do.
Anytime one group gives another group money, somebody's assuming the risk. For most lenders, if I'm giving you money but I get no piece of the business, that means the borrower should be assuming the risk, and they sign a personal guarantee. Why do I like to sign those? Because unless you're a Fortune 500 company that doesn't really need to borrow and doesn't need to sign a personal guarantee, you trade a personal guarantee for equity. What's more important to you, all right? For me, equity's always been more important than a personal guarantee. Damon and I have both signed personal guarantees for Blue Eye.
Yeah.
Substantial. I've signed personal guarantees for others as well. But what it means is, if you're willing to give a personal guarantee, you retain equity in your company. If you're not willing to sign a personal guarantee, in many cases, you don't sign a personal guarantee, but you're giving up equity in the company. And that's when you get to equity, mezz debt, whatever.
Yeah.
But that's the trade-off. And it's very important that people understand that a personal guarantee is not necessarily a bad thing if you believe in your business, because it lets you retain more equity in your company, which ultimately will have the highest value.
Yeah. You have to be smart about it, but it can be really useful.
Yeah, and make sure if you do sign a PG that you run your forecasted financials, that the company has the ability to pay back the cash you're taking.
Yeah.
Which is, again, why you go back to forecasted financial statements, right? You let the numbers tell you that, yes, if I take the money today, here's how I'm going to pay it back. And I have the ability to pay it back based on all these assumptions and variables.
Yeah, that's why the cash flow is so important.
Yes.
Yeah.
Yes.
In the business.
Historical and projected.
Yeah. All right. Thank you so much. And tell us where people can find you, how they can contact you.
Bill?
Rectify.net. Very simple.
Perfect. Thank you so much for doing this and recording 2 parts of the conversation. And thank you for listening. I hope that you'll have a great night, day, and whatever time it is for you. Thank you so much. Bye.